Why paying off your mortgage early can be a liquidity trap. You did a discipline thing. You killed the debt. No payments, no bank. That felt like freedom. And it was. For what? Because discipline has a blind spot. You moved capital into something permanent. Walls, foundation, drywall. The liquidity is the real safety net, not net worth. That payoff felt safe because nothing was due, but nothing could move. Fast forward, the business loans, the phone rings less. You don't panic, you pause because your wealth is real, but it's trapped. And the danger isn't that. The danger is discovering that being debt-free removed your options right before life applied pressure. When income hiccups, when health interrupts, when timing matters, that's when you'll understand what actually broke. Hello, my name is Robert Balkach. I'm the founder and CEO of Black Swan Insurance Group. And since 2017, we worked with more than 20,000 families, many of them entrepreneurs who did everything right and still found themselves boxed in by their own discipline. We've earned over 855-star reviews by redesigning financial structures that hold up when conditions change. This isn't a critique of responsibility. It's a conversation about the timing risk, about what happens when well-intended decisions quietly remove flexibility. If this resonates, you can click on a book below and book a private strategy conversation with us. No sales pressure, no product pitch, just structural clarity. Because the next story isn't theoretical. It's happening every day, and it always breaks the same way. Meet Victor. Victor is 43 years old, and he owns an auto repair shop in Texas. Conservative by nature, built everything slowly, scarred by 2008 when credit vanished and friends lost businesses overnight. Victor made a promise back then. I will never let a bank control my future again. So when the shop became profitable, he attacked the mortgage. Every strong year, every surplus dollar, principal. At 43, Victor owned his home outright. No mortgage note, no lender. That payoff letter sat in his desk drawer like a badge of honor. Victor slept well. Until a few things happened, not catastrophic, just real. Car counts dipped, part costs climbed, and a key technician that has been with him for a while left the company. Cash flow didn't collapse. He just spiked. And Victor looked around and realized something uncomfortable. Most of his net worth was locked in three places: the shop, his home, and a taxable account exposed to market swings. And the house, the asset he was proudest of, was the least useful. To get liquidity, Victor had options. None of them good. Sell investments after a volatile year, pull more income and trigger higher taxes, or refinance the house he had just freed. Victor didn't make a reckless mistake. He made a rigid one. Because being debt-free didn't make him flexible, it made him dependent on timing. And timing is where plans start to crack. Point number one, equity is not access. This is the first illusion. Equity equals liquidity. It doesn't. Home equity is theoretical until you ask permission to use it. Banks decide. Rates decide. Markets decide. Timing decide. Victor had over 7 figures tied up in his home, and he couldn't access 100,000 of it quickly without underwriting, appraisals, and interest rate exposure. And here's where taxes enter the picture. When business income slows, entrepreneurs often default to taxable solutions. Selling appreciated assets triggers capital gains. Pulling more income accelerates ordinary tax. Liquidity is the real safety net, not net worth. Victor's mortgage payoff reduced the interest expense, but it concentrated capital into an asset with zero timing flexibility. The issue wasn't the house, it was optionality, because the next risk isn't market volatility, it's interruption. About a year later, Victor needed back surgery. Nothing permanent, but enough to pull him off the shop floor longer than expected. Revenue softened further, and this is where many plans quietly fail. Disability insurance helped partially, but it didn't solve timing. Selling assets still meant locking in taxes or losses. Borrowing from banks meant renegotiating from a position of weakness. What stabilized Victor wasn't selling anything. It was access. Years earlier, almost by accident, Victor has redirected part of his aggressive mortgage payoff into a properly structured index universal life policy. Not as an investment, but as a liquidity reservoir and designed under the IRS tax code 7702, carefully funded to avoid 7702A max status. The policy built accessible cash flow, policy loans, not income, not taxable, no credit checks. During the interruption, Victor accessed cash without triggering taxable income, without selling assets after market drop, and without asking permission from a bank. This didn't eliminate risk. Loans accrue interest, caps still exist, fees still exist. Poor design breaks this strategy, but a good design holds when life applies pressure. And Victor didn't add complexity. He replaced a hidden stress. Most people wait until the interruption to discover this. Victor barely got there in time, which leads to the next failure point. Point number 2, timing risk beats math. Aggressive payoff strategies look unbeatable on spreadsheets. Guaranteed return, lower interest cost, psychological peace. But spreadsheets don't model life. They don't show income pauses. They don't show health interruptions. They don't show markets dropping at the exact wrong time. Victor's mortgage payoff was mathematically efficient. Structurally, it was fragile. By contrast, the liquidity structure gave him control during uncertainty. Not forever, not guaranteed, but intentional. Liquidity doesn't eliminate risk. It absorbs it. And the moment you realize that is usually late, because the final risk doesn't arrive as a crisis. It arrives as a transition. Point number 3, stepping back exposes structure. Entrepreneurs don't retire. They step back. When Victor reduced his involvement, his income shifted. Tax brackets changed. Asset sales became visible. Timing mattered more than the tools. The payoff house still didn't move, but the liquidity structure allowed him to supplement income strategically while the shop matured and his role evolved. Not by selling, not by triggering taxes, by design. This is where many disciplined people discover an uncomfortable truth. They didn't build flexibility, they built permanence. And permanence feels safe until life refuses to stay stable. Here's the verdict, using Victor's actual design. Victor funded $100,000 per year for 18 years, a total of $1.8 million, redirected from the aggressive mortgage payoff as surplus cash. By the age of 65, the policy is projected to have $2.8 million in accumulated cash value. From that structure, Victor could access approximately $258,000 per year of tax advantage income projected through his early 90s. And that income was available without triggering taxable income, without selling assets after market drops, without asking permission from a bank. No guarantees, caps still apply, loans accrue interest, for design fails, but structurally, this replaced the liquidity trap with optionality. Victor still paid off his home. He just didn't sacrifice flexibility to do it, because liquidity is the real safety net, not net worth. So if you're aggressively paying down debt, this isn't a warning, it's a timing adjustment. Discipline is powerful. Rigidity could be expensive. So if you want to see whether your current structure creates flexibility or traps it, you can click on the link below and schedule a private design conversation with our team. And remember, it's not what you earn, it's what you keep. Enjoy the ride.